Jesus.
S&P 500 program trade buy level 1.
It's your wake-up call, pal. Go to work.
Okay, in this podcast, we're going to talk about the micro crude oil futures. We've spoken about micros before, and we've spoken about crude oil before, but never in the same sentence. Until this week, we're going to talk about micro crude oil. It's a new contract that is listed or made available on the CME, and so far so good. It's now 4 days into its listing. I've been watching it closely, and we're going to talk about it today. So, first up, about micros. If you're not familiar with the concept of a micro, the micro is not a different style of futures contract as such. It simply refers to the contract size. They're essentially smaller, no prizes there. The upside is smaller, the downside is smaller, and the commission rates are smaller. We'll talk about commissions later too. But first, a bit of history. I suppose you could say the micros started with the mini S&P, the E-mini as it was called. Some of them just called the mini now, but the E-mini S&P 500 was introduced in 97. It was a smaller dollar value than the regular S&P contract at the time. Back then, I think the big contract was $500 per point. Index goes up 1 point, $500. Index goes down 1 point, $500. That split, I think around that time, into a $250 contract, and the E-mini was introduced, and it was a $50 per tick, or per point, I should say, per point contract. So the reason that was introduced was because as stock indices or prices go up, your volatility goes up in point values, even if it doesn't go up in percentage value. So it became, as stock markets grew and grew and grew, as bull markets happened and so on, the standard tick sizes for contracts became essentially more risky, more volatile, more expensive to trade. Along comes the E-mini, $50 a point. It took off, sold like hotcakes. Brokers loved it. It did really well for the exchange, and of course, it was a great product for small traders, and still is. But you know what? The market keeps growing, right? So that E-mini contract isn't as small as it used to be in volatility terms, anyway, dollar volatility terms. So what they've introduced recently is the micro, what they introduced 2 years ago was the micro S&P. In fact, the first micro that came out was 2009. It was in the foreign exchange market, micro FX. Micro stock indices came out about 2 years ago. We've now got the micro S&P, the micro Dow, the micro Nasdaq, and the micro Russell, which is a great contract to trade. We've spoken about that in another podcast. But now we have crude oil. So I won't get off the topic too much because we want to talk about crude oil. And you know what? A not so risky forecast is we'll see other micro contracts as well. Again, I'll talk about that later too. I need more podcasts. We'll talk about that. For private traders, these things are exciting because they introduce a whole world of strategies and possibilities, and they allow you to trade with lower risk, greater for new traders, greater for different styles of trading, greater for diversification, you know. So just quickly, the details. The micro crude oil is 1/10 of a regular sized contract. If you've traded crude oil futures before, you know it's a 1,000 barrel contract. So if you buy and the market goes up $1, you make $1,000. If it goes down, you lose $1,000. The micro is 1/10 of that, so it's $100 instead of $1,000. It's 100 barrels instead of 1,000 barrels. Right? The tick size is exactly the same. It's 1 cent. So in crude oil, in the big contract, I should say, the big contract is $10 per 1 cent move. In the micro, it's $1 per 1 cent move. It's a tiny contract, and the initial margin, the margin deposit is $530. And that is, guess what, 1/10 of the big one. So for smaller traders, you dipping your toe in the water, it is a great contract to be looking at. How we're going to use it? Well, if it's just for trading directional positions, it's, as I said, it's great for new traders. You can take a position and not risk a heck of a lot. You can leave wide stops and know that you're not going to have to mortgage the house to pay off your account. Right now the average range in crude oil is about $1.80 per day. That's the average true range figure that I read off my charts here. For the big contract, that's $1,800 per day, right? That's an average range. But for the micro, guess what? It's 180, not 1,800. Okay, so for scalpers such as those in my DOM bootcamp, trading strategies like market making, averaging in and out, and highly active intraday trading, it's brilliant for that. For those new to those strategies, moving from the simulator to a live account is far easier when it's not that big a jump in risk. There's certain limitations in trading with the simulator. All right? Mostly it's not real money, and they're not real orders going through either. So there's a lot that kind of can't be learnt while you're on the simulator. So and I know very well from training prop traders, it's a big jump to go from a simulator into the real market. If we had these micros back when I was at prop firms, teaching new traders would have been a heck of a lot easier to take them from that simulator to the real market. Quite often, that would be a big stumbling block for new traders, all in the mindset, of course, but it's also a matter of how much they're allowed to risk, and in a prop firm, at least the prop firms I'm used to, we'd have a daily risk point for each trader, a daily stop, if you like, a soft stop and a hard stop. And with something like this, though, even if you're trading yourself or trading for a prop firm, this opens you up to having a tighter stop and not having to worry about, well, what if I have 3 losing days in a row? Because it's not going to be that much. Now for spreaders too, I should also mention there is a spread market for micro crude oil. This is really interesting. This is really exciting stuff. So there are exchange traded spreads available in these micros, and so far liquidity is pretty good there too. You'll see fewer active trades than in the outrights, true. But those market making bots are in there, and they're tight enough to keep a reasonable bid and ask and reasonable depth there too. So there's plenty for us to get filled. For other spread traders, longer term spread traders, this smaller contract allows you to carry longer term positions without that big risk. Right? So like in our spread course, we look at various strategies where we can apply seasonal trading data. This is ideal for that kind of stuff. And the more of these kind of micro contracts that come out, the more we can build a diversified trading strategy with a smaller amount of money. I think it's absolutely brilliant. And they work for, like I said, both short-term strategies, long-term strategy. Liquidity, I've got to say, liquidity has been good, not great, but certainly adequate, or more than adequate, I should say. With liquidity, you don't need 1,000 on the bid and 1,000 on the offer unless you're going to trade that much, right? Ideally, smaller depth is better because it's easier to read, in my opinion. Right? And in terms of getting filled, you only need enough there for your order, right? So right now there is more than enough there. You'll find you can see these market making bots in there at the moment that are keeping the bid ask relatively tight, and as long as they can still arb off against the full size contract, then that's always going to be the case. So at the moment you'll see, or at any particular time, you'll see the bid ask spread on the big contract to be essentially just 1 cent all the time. In the micros here, I've seen it 1 a lot of the time, 2 and 3. That's going to change. It'll probably be different next week, who knows, or in 6 months or whatever. But it's not going to, it's not going to be as dreadful as those Bitcoin futures, the micro Bitcoins. But anyway, that's another podcast. Why don't we talk about a couple of tips to help you get started in these things? Couple of tips. I would strongly recommend watching if you're analyzing the market either on your charts or on your order flow, your depth of market, watch the full size contract. Most of your screen should be taken up with the full size contract, and then use the micro for execution only. It's essentially the same thing. It's just 1/10 of the size of the full size contract, right? But the reason we look at the larger contract is because it's trading more often. There's more timestamps. It's a busier time in sales, which means, if you're trading off levels on charts, if you're trading at levels of your depth of market, then it's going to be more reliable looking at the bigger contract. Okay, you're still trading the micro, but your analysis is coming from well, it's not the macro, but the big contract. Okay, another thing to do is stick to working limit orders. Don't go head in and just hit market on orders. Even if you do, it doesn't really matter at $1 a tick. It's not going to hurt. But while this market develops, don't feel the need to rush your execution. Just watch and learn and go from there. Okay. Also watch deferred contracts. As I said, there's a spread market available here, so it'll be interesting to see how they develop. At the moment, the first few calendar spreads are liquid enough, and again, 1 or 2 cent bid-ask spread on them, which is great. But it's something to watch as well and see. They're making available 12 contracts, and in crude oil, if you're not familiar, they trade have monthly expirations. So that means right now the first contract is August, then there's September, then there's October. So there's a futures price for each month, 12 months out. So there's a lot of spread trading, a lot of butterfly, all those kind of spreads combinations that you can think of 12 months out. And that's one thing that's great about trading the energy markets, is that you can place those kind of trades because there's that liquidity further out, and hopefully that continues for these micro contracts as well. That means we can get more complex style strategies, and again, not be risking a heck of a lot. I think it's fantastic. One thing to check, with your broker and commissions, your broker should be offering reduced commissions for all micro contracts. The rule of thumb, I suppose, if we could say a rule of thumb, is to look for your total all-in commission. That's less than a tick. So in this case, it's less than $1. For larger size contracts, your proportion of commission to tick size is far smaller, but we have to pay up a little bit for the micros. But in dollar terms, you shouldn't be paying a heck of a lot. If not, get a new broker. Also, ask your broker about span margins. They should be margining for spreads. Otherwise, why are they there? There are plenty of brokers that do offer spread margins, which is essentially, if you're trading spreads, you have reduced margins. Of course, you don't get double margined. Some brokers still double margin, and I don't get it. I don't get why they do. But anyway, let's just wrap it up. Listen, before we wrap it up, if you're new to the whole scalping and spreading concepts and some of the things I've spoken about here, check out my courses at masterclasstrader.com. Check out the link to specials. It'll have a current special. There's my courses on the DOM Bootcamp and advanced spreads are 100% applicable to this micro crude oil market and the other micro contracts too. But check out the specials for a bundle deal for both of those. Also, check out my new Telegram group chat subscription for spreaders and scalps. I'm going to keep this a very small group, people who are actively trading, and it's all about positivity and helping each other out. We'll talk about trades and help each other with other related things. There'll be a link below for all of that, but it's in Telegram, which is a great way to kind of chat. There we go. Now, coming up next month, we'll have micros in treasuries coming out. I already did a little podcast on that with some contract specs, but I'll do another one once the market is live and active. I think they'll be fantastic. And again, they'll have the same advantages of these micro crude oil contracts, which will just open up a wide range of different strategies we can start looking at that have previously tended to be of higher dollar risk or higher complexity. But anyway, until then, good trading. Catch you next time.